So let's just start here. Let's just start with 5 basic characteristics of the Roth IRA, some of which I've talked about in this basic synopsis I just gave about the tax-free growth and the tax-free withdrawals. But we'll cover these 5 quick characteristics. So the first one, right, we talked a little bit about. You pay taxes on the money you put in the account, but you cannot deduct the contributions on your taxes, right? Any money that you put in, you cannot deduct from your taxes. Now, why is that an important thing? Well, because the traditional IRA, which came before the Roth IRA, the traditional IRA, you could deduct, and you still can if you have a traditional IRA, any contributions you make are tax deductible, right? Those that money will be treated as pre-tax money, whereas the money put into a Roth IRA is treated after tax, right? The taxes have already been paid, and then it is tax-free once it is in the Roth IRA. Whereas, again, the traditional IRA, you get the tax deduction on the front end, and you pay taxes on the withdrawals later on, and it grows tax deferred, right? You defer the taxes to the end when you make the withdrawals. Then the second characteristic of the Roth IRA, in 2020 and 2021, you can contribute up to $6,000 in a Roth IRA if you are younger than the age of 50. But if you are 50 or older, you can contribute $7,000 into an IRA. And if you're married, right, you and your spouse can each have a Roth IRA and each contribute whatever the max is based on your individual age for that year. And the reason I said 2020 and 2021 is because let's say you didn't open a Roth IRA last year, right? But let's say you're at the point this year, you have a lot of money laying around that you want to invest for your future, you want to invest for retirement later on. You can put that money in a Roth IRA, and you can put it in a Roth IRA and treat it as last year's contribution until you do your taxes for this year. Okay, so until you do your taxes, until April 15th of this year, right? You can, and they may have extended the tax date, so don't hold me to that. I know they extended it last year. But until the tax date, you can make contributions to an IRA for the year before. So you can still make 2020 Roth IRA contributions. So you could, hypothetically put $6,000 for last year if you are, under the age of 50, and then another $6,000 for this year. So you've got a lot of room to run when it comes to this year's contribution if you haven't started a Roth IRA before. Now, the third characteristic of the Roth IRA, you cannot contribute to a Roth IRA if your modified adjusted gross income, the MAGI that you see when you're going to file your taxes, was more than $139,000 in 2020 for single filers, or $206,000 in 2020 for married filing jointly. In 2021, the MAGI limit is $140,000 for single filers and $208,000 for married filing jointly. So there are these limitations on your income in order to contribute to a Roth IRA, but most people fall at or below those income limits, which is extremely helpful. A lot of people can take advantage of this tax advantaged account, this tax-free growth, these tax-free withdrawals of the Roth IRA. And even if you make more money than these modified adjusted gross income numbers, you could still backdoor your way into a Roth IRA. This is what's called the backdoor Roth strategy. And basically the whole idea of the backdoor Roth is you make a contribution to a traditional IRA, right? Because traditional IRAs do not have income limits. Yes, they have income limits on the deductions, but we're not talking about traditional IRAs right now. We're talking about Roth. But you can make a contribution to a traditional IRA, and then you can backdoor, you can convert that traditional contribution into your Roth IRA, meaning you pay taxes on it and you move it from a traditional IRA into a Roth IRA. Now, I would definitely suggest getting with a CPA before you ever do this, because there are some rules surrounding it, and especially if you do it more than once or you do it on different lots of money, I would look for the advice of a good CPA in order to make sure that this is done correctly. But even if you make more than those modified adjusted gross income numbers, you can still put money into a Roth IRA. You just have to make sure that you do it within the bounds of what the IRS allows you to do. And the backdoor Roth strategy is 100% legal, is 100% allowed, but it is just a bit of a loophole that is just left open by the IRS that many people take advantage of, and normal people like you and me take advantage of every day. 100% legal, 100% able to do that. But again, just make sure that you get the advice of a good CPA before trying to do that on your own. That may be something that you need a little bit of guidance, a little bit of help on before working through it. Now, the fourth characteristic of the Roth IRA is people at least 59 and a half years old and who hold their accounts for at least 5 years can take distributions, including earnings, without paying federal taxes. Okay, so what does that mean? That means once you hit 59 and a half, right? If you've had your account for at least 5 years, then you can take out not just the money that you've put in, but the money that you've made. You can take out any of the money within that account, and everything is tax-free, no problem. And so that is the fourth characteristic. Then the fifth, you do not have to take any money out of the Roth IRA if you don't want to. There are no required minimum distributions, RMDs, right? RMDs are specific to traditional IRAs. Traditional IRAs have these things called required minimum distributions. Used to happen at age 70 and a half. Now they begin at age 72. And these required minimum distributions are basically the federal government requiring you to pay taxes on your money. The thing about the Roth IRA is you've already paid taxes on that money. So they don't care when you take the money out. They don't care if you ever take the money out because you have already paid taxes on that money. Whereas the traditional IRA, you have yet to pay your income tax on that money because you got the tax deduction on the front end, and then they want their money at some point before you are to pass away. So they require these minimum distributions that you are to make that typically begin a little over 3% of the account's value over the course of the year. And so, but again, these are not for Roth IRAs, only for traditional IRAs, which is a distinct advantage of the Roth as well.